our wealth strategy. Today, I'm going to talk to you about the difference between the income statement and the balance sheet. And we will see the examples not only between one and the other, but we will also see the difference. What do the rich do that make them apart from those people who are not rich? Okay, so we're going to go into that. Let's get started with Robert Kiyosaki. I'm going to use his examples as I believe he's seeing things the way I also, well, I see things as he sees. So I like very much. He's my mentor, and so I like to share what he says, the way he explains things, And I would suggest that you read his book, Rich Dad Poor Dad, if you haven't done it yet. He has many more books, but this one was the first one and is still very, very good. Okay, Rich Dad Poor Dad, Robert Kiyosaki. And he explains that there is a cash flow quadrant. And we'll get into the cash flow, see how it goes from the assets and from all that. But when you talk about this quadrant, well, you have on the one side, you have those who exchange their time for money, and on the other side, you have those who have the money working for them. Now, what is E? E stands for employee, people who go to work. They work for a company, they get the salary. If they don't work, they don't get their salary, okay? Then you have the S. S stands for self-employed. It's when you work on your own and you don't really have a business, you have a job or something, and maybe you have a few employees, but it's not yet a business or a big business. All right. So you are on your own, but if you don't work, again, the business doesn't go. It doesn't turn because it needs you in order to move forward. Okay. Then you have the business, and by this business, we're talking about a big business, a business where you're the owner, but if you go away for a year, nothing happens. And the business keeps going as if you were there. It doesn't matter. It's already big enough to have it going. And then you have the I, which stands for investor. So it's people who have invested their money and they make their living from the revenue that those investments provide. Okay, so this is the principle. So the idea is to move from this side of the quadrant where you change your time for money to this side of the quadrant where you have the money working for you. All right, so you are on this side, you're financially free. Okay, so let's look at how this translates from an income statement and a balance sheet. So let's start with the income statement. So the income statement is basically here. This is for somebody who is not rich. I will show you the rich one in a moment. Okay, so this is someone who has a salary and then he has his expense. So income, expenses. This is the income statement. Income and expenses. The income is the salary. The expenses is all the rest. Taxes, mortgages, the card, living expenses, the credit cards, the schools. Everything is in the expenses. Okay, but the income is the salary. All right. So you have these two. Then you have the balance sheet, and the balance sheet is like this. On the one side you have the assets, on the other side you have the liabilities. And on this side, you have no assets. So, and the difference is that the rich, they have assets here. Okay, we're going to go into that in just a moment. So you have no assets, but you have all the liabilities, which is all the debts, the mortgage, the loans, the credits, the credit cards, all these things, the debts that you have that are in your liabilities. However, no assets, only liabilities and no assets. So the balance sheet looks like this. No assets and lots of liabilities. All right. So this is somebody who is not rich. So again, when we look at this, okay, we see the income statement The income statement, you have the salary, you have the expense, so the income is the salary, expenses, all the living expenses, and then as no assets, and you have the liabilities. All right. So this is the principle of income statement, balance sheet. Now, what is the difference with a rich person? A rich person has same thing, income statement, and so income and expenses, but the income does not come from a salary. I mean, they can also have a salary, but basically they have their main source of income comes from rentals, interests, dividends, royalties, anything that intellectual property, the patents, that kind of stuff. So that brings money in to in here, in your income statement. And the expenses, well, it's your living expenses. You have your taxes, your mortgages, your credit cards, whatever expenses you have, those come in here. But the income is not from a salary, okay? Or the main source of income is not from the salary. And when we look at the balance sheet, okay, so we have the assets, the liabilities. And now here we see loads of assets: real estate, stocks, bonds, notes, intellectual property. All these things are on your assets and they generate revenue. So that's your income. Your income comes from your assets. All right. And then you have your liabilities, which is the loans, the mortgages, the credit cards, all these things. So all the debts that you have, they are on the liability side. Then you have, but on the asset side, you have all these assets. All right. So when we look at this again, let's compare the income statement from somebody who is rich compared to somebody who is not rich. So you see the difference? I mean, the expenses are basically the same. Okay, I didn't write all this here, but it's the same thing, expenses. But the income, it's the salary, but here it's all the other stuff. All right? Do you understand this? Okay. Then we have the balance sheet. And here, when we look at these balance sheets, we can clearly see the difference, right? So you see that you have no assets and you have the liabilities, and the rich have loads of assets, and of course they also have the liabilities. All right, you see the difference? Okay, so this is pretty obvious how they operate, how they work. Okay, now let's look at the goal. Let's look at the goal for this. So essentially, let me just put my cards away. The goal is this: you have your income statement with your income and your expenses, and you have your balance sheet with your assets and your liabilities. And what you want to do is to have your income generated from your assets. All right. You can also have a salary if you want, but the main source of income is your assets. So this way you are financially free, because if you don't work, well, your assets are working for you. They are producing income. They are generating revenue, and you're going to have it. Okay. So why is this important? Because how you earn your money is how much tax you're going to pay. So on top of everything else. All right. So when we go back to the quadrant, we can see that employees are heavily taxed. They pay about 40% taxes. The self-employed, they are even more taxed, because they pay not only their taxes, but they pay the taxes from the people that work for them. All right. So they pay huge amounts of taxes. And then you have the business, where they pay 20%, that's corporate tax, that's it, on the profits, and the investors pay zero. Now, of course, they pay zero if they have structured their investments properly, okay? Because there are many ways you can also make investments and pay tax, but if you structure it properly and legally, well, you can pay zero tax. and that is the goal. All right. So it's really important, this concept of income expenses on your income statements, and then your balance sheet with assets and liabilities. All right. Good.